Welcome back to Mining Stocks. Today we're joined by Drew from Stallion Uranium. They're listed on the TSXV under the ticker symbol STUD. I'm very excited for this conversation. It's a company that has some really exciting uranium projects, not to mention some really cool gold projects that they've been holding for some time now. I've really been looking forward to this conversation, Drew, since we first connected. I think it was back in December. So I'm really happy to get into it. But I've always been curious. I feel like a lot of mining is dominated by folks who have been around the space for a very long time. What got you into mining so early on? Like, how did you get into the mining space at all?
Yeah, no, it's a great question, and thanks for coming to sit with me today. I appreciate the time that you're taking. For me, I was on the other side, so I came from the finance side of things. I was a decade at a national brokerage firm, but I specialized in derivatives. So I was commodity, big picture markets. So I used futures and options for those sort of opinions, but I always got to see sort of the big macro things unfolding. And that was my strong suit, was being able to sort of tell what sector might do well for, months or years ahead. And then you would position yourself for that. So to be able to come and step over for both gold and now uranium, it was the opportunity to start to build a company. And again, I'm a small town farm boy from northern Alberta. So getting caught up in the city where you're just moving paper back and forth, was good and exciting for a decade. But when it came to that next decade and the opportunity to work with a good group of people to start to build a company that I think can make a real difference and do well for our shareholders, that was an exciting opportunity that I couldn't pass up. And, here I am 3 years later and incredibly happy that I took that leap and, continuing to build as we go.
Interesting. So you were in derivatives, you were in the markets on the investor side, on the buy side. And so now, what was the opportunity that came about? Like, I mean, you guys have some great folks in Stallion, but what exactly happened? Like, how did that come about?
Yeah, the opportunity was Stallion basically at inception. October of 2020, they just raised $3 million. And needed a CEO to sort of take that capital and go and find the asset that they wanted to bring in. So they were looking at people, and that's where the opportunity came up for me, within the network that I built out over a decade being in the financial space. At the beginning of COVID, I think, like a lot of people, took some time to reflect on, what's happened in my life up to this point. If the world ends, what does it look like? And where do I go from here? And it was in that reflection I realized I had enough of doing the same thing. And if my decade ahead looked just like the decade past, that wasn't all that exciting for me. I wanted to challenge myself, scare yourself a little bit by going out on a limb. And that's what I did. So when I'd sort of put the feelers out, this was one of the opportunities that came up. And it was one that I got really excited about and sort of dove into head first. And right out of the gates, we got the Horse Heaven project, our big Idaho gold project, and just continued to go and build and try and make smart decisions from there. And here we are, 3.5 years later.
So you were looking at the macro trend, right? You were looking at what is going to be going on as a whole in the markets. What was the thesis that you had that made you go into Stallion at that time?
Honestly, this was the gold highs of 2020, right at the end of 2020. And I thought we were going to see what we're now seeing, 3 years later. It was gold, really break out and continue to run. Governments had just printed so much money through the COVID crisis that you kind of saw, okay, this is the opportunity for that hard asset to really start to move. And, I timed that poorly, to be honest, because, gold topped shortly after and then rolled over, went lower. But again, it was the opportunity there to get that gold asset, to pick up another gold asset when prices were depressed because gold had rolled over, picked up a Richmond Mountain project for a song because nobody was interested in it or that area. But again, it was sort of that ability of saying, okay, what sector do I think is going to work? And, it was gold and the precious metals, but also the ability to get into the commodity sector. I see that the commodity sector has been hugely undercapitalized since the big run up in 2011 that was, based on, China's going to buy everything that's not nailed down narrative. And because of that low capex, we just don't have the supply of commodities sort of in a lot of different facets, whether it's precious metals or base metals or critical minerals. And I think that is now what we're starting to see, where, a lot of commodities across the board are starting to move. So if you're going to get yourself in and start positioning yourself, you want to do that early. And I think that was in the thinking to go to, the other side of the street, so to speak, from where I was at, to say, okay, if I really believe in that, I think commodities will go, put their career in it rather than putting a trade on.
Yeah, fair enough. If it's going to be a big win, then why not? So what do you mean by commodities were undercapitalized? Like you said, like you had that run in 2011, but tell me more. Like what was the missing? Like what was the gap that you saw?
Well, I mean, one of the old sayings in the commodity market is, high prices are the best fertilizer for next year's crop. And, that comes with the grains industry, especially, if corn prices shoot up, everybody plants more corn for next season because it's worth more. So, in other commodities where it's not a annual cycle like crops are, you're seeing, that CapEx, run up when prices run up like they did in 2011. And then all of a sudden you have more supply than you need and prices come back down. So commodities are very cyclical in nature. And when prices run down, then, companies like junior companies or even developers or producers can't raise the capital to bring projects online. So they stay off of line or they don't get developed. And again, supply gets constrained, and eventually supply being constrained enough and excess inventory gets worked through, then you have to be able to, go from there to bring more money back to the space in order to bring it forward. So that's kind of what I mean by CapEx was constrained. As prices came down, no development went into different assets, and especially in the mining space, it can take 5 years, 10 years to bring projects online. So when you're seeing that low in CapEx, in 2016, 2017, 2018, until it comes back in a big way, that supply is just not there. So now when you see demand starting to pick up like we are these days, it doesn't have the supply or the ability to meet that demand, even with supply that hasn't come online yet.
So for example, in the uranium space, we have right now a shortage that's going on. And so you're saying that shortage has come about because of lack of investment from before, right? And then how do you capitalize on that existing shortage?
Yeah, exactly. So I think the important thing there, and when we started to do our due diligence on uranium assets, which were coming up on almost 2 years ago, when uranium was $40-$45.
Wow.
Understanding that the market had a structural supply shortage, and again, you look at some of the uranium funds that have been set up. I mean, they saw this coming in 2017, 2018, when prices were much lower than that $40 mark. But again, it was for us to be able to get in and say, you have a pipeline of how things get from being discovered to being developed to actually going into production, and that pipeline takes some time.
Okay.
And when uranium prices last ran up to $140, $145 a pound, you had supply getting brought online. You had more money go into exploration, and it was for us, we're in the southwest Athabasca Basin. Triple R get discovered in 2012, and you had Arrow with NextGen get discovered in 2014. That was on the back of the strong run up in prices that allowed junior mining companies to fund themselves to go out and do the exploration necessary to find those deposits that are now just hopefully going to come online at this cycle at some point to help satiate some of the demand that's there. Because like anything that's getting mined, it's finite.
Right.
You mine it, you use it, and then you need to find more of it, mine it, use it, and go on. So for us, it's really about being able to say we can capitalize on prices running higher, because as we've seen in this cycle already, the producers and the developers have run to all-time highs. But investors need to realize, even if we develop everything that's been found already, we have a huge shortage. We need to find more uranium, and that value for uranium in the ground goes up and up and up as the commodity price goes higher. So for us, it becomes incredibly lucrative to say, go out and explore. If we can find a big deposit, if we find 50 million pounds or 100 million pounds, I mean, if you can bring 100 million pounds out of the ground right now, that's 10 billion US in revenue, right? It's a significant discovery that's worth a lot of money. So that's where investors start to go, okay, with prices so high, I'm willing to go down to the junior explorer, put some money into them because pounds in the ground are worth so much and we need to find more of it. And that's what, incentivizes us to go out there and do that work.
So investors look at the opportunity as there needs to be more uranium over the next decade. How long are we looking? Timeline?
Yeah, honestly, I mean, as of right now, until prices get even higher to incentivize what are still uneconomic deposits or new technologies come to find uranium, and be able to, harvest it at an economic model. As it stands, the supply-demand gap goes like infinite. Right now. I mean, we have a little bit of a near-term help if both NextGen and Fission come online. That's going to be, close to 38 million pounds a year, which will really help because right now we need that. And when you look at the supply-demand curves that, the World Nuclear Association will put out, we're at a structural deficit.
Mm-hmm.
And, they're only modeling in current reactor demand, and some of the new ones that are getting built, they're not factoring in a lot of life extensions that have been happening recently. They're not factoring anything to do with SMRs. And now you read about, how much data centers and especially AI data centers are consuming as far as electricity, and the fact that these big tech companies really want to stay with a zero carbon footprint. So how do you power these things? You have to put them, next to a nuclear facility or an SMR, co-locate them. So there's an incredible amount of demand that we see, really unable to be met by current deposits that are in development going into the next couple of decades. So it makes it an incredibly exciting place to be a part of because the market needs to incentivize junior companies, or all companies in that matter, to go out and find more uranium and find more ways to bring it to the market. So that's what we think is really exciting for us, because in order for us to get incentivized, it all comes back to the commodity price. You don't incentivize the market with $90 uranium. You don't incentivize the gold market with $1,200 uranium. You incentivize gold producers with $2,400 gold. You incentivize uranium producers with $150, $200 uranium. So that's where we become the lever, because we are so small. When this market starts to go and people say, we need to find more of this, who do we fund to go do that? That's when the junior explorers can do really well. So I think we're just starting to come into that part of the cycle where the producers and the developers are at all-time highs, but the juniors are, a lot of us, sort of near multi-year lows. But again, doing a lot of good work that we think will get recognized to say, and the investors say, we need the work that these guys are doing. And then if we have any success, it's a significant re-rate potential from there.
Yeah, I mean, you make money from when you buy, not from when you sell, right? So if you're at an all-time, or if you're at a low over a few years, that's usually a good time, depending on the market conditions. Yeah. But I think that what's happening now is people are starting to realize that, okay, there's a shortage, so we need more uranium. But they're, like you said, they're not taking into account the amount of new nuclear power plants that are coming online that need uranium. And the funny thing there is that, like, a lot of it was supplied by other countries too. Like if you look at US and North America specifically, and that's a challenge by itself. But also, more and more companies are trying to be green. More and more power is needed. More and more countries are trying to incentivize the green movement. So I think that it sounds like the first wave was realizing we have a current shortage. The second wave is realizing there's a long-term shortage. And that's where the junior explorers really come into play, because those are long-term, pictures that you're looking at. You're looking at a long-term play of something that's going to go. Are you guys going to go into production? Or do you think you want to, exit to a larger producer? Like, what's your game plan for the assets?
Yeah, for us, I mean, I think you hit the nail on the head there. We've had a run up from, $20 per pound in uranium all the way up to 100. We've set back, we're around $90 a pound now. And that was very much on the market right now being structurally undersupplied, and there's not a lot of secondary inventory available. And now when you look at we're trying to electrify the economy to get to net zero by 2050. And then even just in the last year, really, with, ChatGPT coming onto the scene and the amount of data centers and power that AI is going to consume. I mean, McKinsey just put out a piece saying it's going to go from 15 terawatt hours to 45 terawatt hours by 2030. This is not out by, we're talking the next 6 years. Like, that is a huge step up. And they're saying, US power consumption by data centers is going to go from the current 4 or 5% to 20% in that same time period. Like, it's absolutely astronomical while we're trying to, electrify our vehicles and everything like that. So, where we're getting this electricity and how we're getting it is critically important. The last thing we need is more coal power plants to be able to do this. So again, that's, long-term nuclear outlook that I think gives people confidence. And that's what it always comes to when it's investing. How confident are you in a narrative? The more confident you are, the more money or capital that you'll put at risk. And I think when people get more confident and comfortable with the longevity that they see in this nuclear cycle, then they can say, okay, I don't need to just be in Cameco anymore. I can look at some of the producers, maybe, or developers like NextGen, Dennis, and Fission, or they say, they're at near all-time highs. The opportunity really looks like it's in these juniors. And then for us, of course, the big opportunity is discovery. Because if we have a discovery, right next to us, where we're drilling now, our property is F3 uranium. Last year they hit one discovery hole. They went from a 20 million market cap to 150 in 3 weeks. They're now at 200 million as they try and discern how big that deposit is. But again, significant re-rate potential, especially in the Athabasca Basin. And for us, it's being able to make that. And we think, especially in the Southwest, where there isn't currently a uranium mill, but again, both NextGen and Fission planning to build a mine and a mill, they're going to have new infrastructure that comes to our area that's going to want to have more ore, so more pounds in the ground that will be able to feed into this new infrastructure. And again, it's going to take some time, but even for us, we have to make a discovery, turn a discovery into a deposit. And then we think that's an incredible opportunity to whoever is operating those mines and mills in the Southwest at that time, whether it's NextGen or they're owned by somebody else that's bigger, being able to have a junior explorer that's gone out and found pounds in the ground. Those pounds in the ground become very exciting and very meaningful on a dollar value of pounds in the ground because they're going to feed infrastructure that has just been built out. So that's our view. It's not our intent to do what NextGen's done or Fission's done, where they've gone from a discovery company into a developer company. We think in this cycle, and we think that prices are going to run so high that if we find pounds in the ground, it'll be a good premium to be able to sell those pounds in the ground. So
makes sense.
Yeah.
Makes sense. So what do you have on the outlook for the next 6 months? What are the key milestones that you're looking at?
For the uranium market or for Stallion?
For Stallion.
Yeah, for Stallion, it's incredibly exciting right now. We're in our main drill program. So it's a 3-hole program. We've announced results from our very first hole. Again, Stallion's strategy has been start really big. We built up the biggest land package in the Southwest Athabasca Basin, all around, NextGen, Cameco, S3 uranium. But it was to take that really big data and do very efficient, large regional surveys to focus in on the best potential areas that we think could host that next big deposit. Because Stallion's all about looking for the next Cigar Lake, the next McArthur River. We want to find something big that moves the needle on a global scale, like Arrow does.
Mm-hmm.
So for us, it was being able to take those targeted areas, do more advanced work. So we did an on-the-ground survey over our Appaloosa target where we're drilling now. And then, like I said, that very first hole, we hit in a downhole gamma probe, 1,500 counts per second, which, again, it's not, big discovery goal. But for your very first hole on a greenfields project to be able to hit any radioactivity, one, it told us that the structure that we're looking at is fertile for uranium mineralization. Mm-hmm. It checks all the boxes to be able to have a big deposit. It's right off a conductor. It's got gravity low, magnetic low, right now by a big domain boundary. So again, a deep-seated geological structure that allows fluid to flow. And 13 kilometers to the west is Shea Creek, 100 million pounds in the ground. So we know the area is very fertile. And now we know we got a sniff of uranium, and now it's just finding again, a lot of the uranium deposits, get described as being a bit of like a pearl necklace. So you sort of get a pod and then a bit of a break where there's a string and then another pod.
Interesting.
So we think we, kind of went through where the string is, and now it's just finding where that pod is. So we've got 2 more drill holes that will be announced over the coming weeks and months as they get completed. Incredibly exciting, for us to be able to hit that on the first hole. Again, many other exploration companies will, F3, again, found the most recent high-grade discovery in the Southwest Basin. Their first sniff hole, big sniff hole like we just got, was hole 19.
Oh, wow.
So again, it's being able to do a lot of very good work with the best technology available to put our drills in the right place, but increase our probability at, finding something with the most advanced techniques that you can use in uranium exploration right now. And again, I think, those results we saw on hole number 1, knock on wood, are always a little bit of luck, but also part of our strategy to say, we know what we're doing. We've been able to, effectively understand a very large land package and focus in on other areas. And I think that's the exciting thing for us. This is, one of 7 or 8 top tier targets that we're drill testing now. And it's one of our deeper ones as well. So we're also bringing up several other, high priority targets that we think, if they were in the Eastern Athabasca, would have been drilled 30 years ago. They're, that enticing. They look that good. And we're bringing those up at the same time. So we're, got a lot of shots on net within the company. And, this is just drill program number 1 and 3 holes. But again, going to teach us so much, and excited to see what the next couple of holes brings.
Yeah, I'm definitely going to be keeping in touch, and we're going to see what happens here. I'm super excited. I like what you guys have been doing. Like I said, I've been watching you for a while. So congrats on that first hole, and a little bit of luck, but mixed with, I'm sure, a lot of hard work. So
absolutely.
We'll circle back again. We'll be in touch and see how things go.
Perfect. Well,
thank you so much, Drew.
Great to see you.
Appreciate it.
Cheers.
Cheers.